Hey everybody, it's Patrick Moore with Ironclad Wealth Management here, and today we're going to have some fun and talk about how you can save money on saving state and local taxes. Now, the reason we're talking about this is there has been some recent changes in legislation, and depending on which state you're in, it may be a couple of years, it may even still be in process, but that's what's causing us to talk about this today. Now, to get this out of the way before we start, is that I am going to be talking about general tax information, okay? This is not individual tax advice. If you think this applies to you, and I hope that it does, take it to your CPA, take it to your advisor, whoever that may be, and figure out if this makes sense. However, with that being said, my goal is to provide you with actionable information that you can take away from this and put in practice in your real life. Okay, this is information geared for business owners too. So that's my clientele, that's who I work with. If you're somebody who is a W 2 employee, unfortunately, this won't apply. Now, the real problem that we're facing and what's caused this to be a presentation or a video I would even record is that there's some pretty significant changes that happened when the TCJA, which was President Trump's tax bill, was passed in 2017, and after the bill was passed. So if we look at this chart on the right here, what you can see is I have somebody making $1 million a year with a 37% tax bracket, 5.75% state rate because I'm in Georgia. That's the state rate. These numbers look better or worse depending on your angle if you're California or New York. Now, in Georgia, that results in state taxes of $57,500. And before the TCJA was passed, that would mean you could get a state tax deduct or a federal tax deduction of that same state taxes paid, or $57,500. However, if you look to the right, after the bill was passed, those state and local taxes were limited to $10,000 per person, and it was also subject still to that same standard deduction limit, which means that in this example, you went from getting a $57,500 deduction to a $10,000 deduction, which resulted in about $17,575 of additional federal taxes. So that's the problem. That's what we're working on, right? And there are solutions, luckily. So if we move forward, the solutions that have kind of been in the works since that bill was passed is something called a PTET election or PTET legislation, depending on which state you're in. What PTET stands for is it stands for a pass-through entity tax election. And all that means is that if you're an LLC taxed as a partnership or an S Corp, you can go back to the way it was before, which was the before time was the good time, right? All that's really happening is they're recreating that deduction by you paying your taxes at your entity level rather than your individual level. Now, the election itself and the reason that this exists is because the TCJA specified that individuals were unable to deduct more than the $10,000 subject to their itemized and standard deduction limitations. So what happened is people who write bills realize that, pass-through entities are taxed as individuals. How about we make an election where you can be taxed as an entity to get around this and still have that deduction for state income taxes passed through? So if you're thinking, well, that kind of sounds, gimmicky and a little weird, well, the reality is, hey, it's not fair, right? Because if you're a W-2 person working a software job, you can't do this. Is this great? In my opinion, no, but hey, it works. Okay, this is the law of the land, and there have been a few, IRS cases, revenue rulings that have reviewed it, and they haven't, endorsed it, right? But they have kind of stood up under the scrutiny of the IRS. Now, looking at this, these are all the states that you look at. You're like, is only one or two states doing this? No, it's 30 states doing this. It's red states, it's blue states, it's really anyone that wants to try and lower the tax burden to keep more people in their state. So if you look at this, really the biggest holdouts are going to be those states that already don't have an income tax because it just doesn't matter to them. So what is the effect? Well, if we look at the chart to the right, essentially it's just reversed, right? The same person, same tax setup, they're kind of just going back to the way it was before, and they're going to save about $17,000 rather than have that increased tax treatment. You're basically going back in time to the pre-27 events. The catch is, though, is that it doesn't apply to all of your state income taxes. It just applies to those corporate, kind of business income taxes that you're paying. So if you have a spouse who has a high earning W 2, if you have your own W 2, your income withholding on that isn't going to go towards this. It's just going to be your business income. So out of the $1,000,000, if your business only earned 500,000 of that, well, then these impacts would be a little bit reduced. However, you can see that really doing this can result in some substantial savings. If we just take things evenly, and it doesn't always work evenly because there's always going to be some exception, but if you earned half of this, you'd still be looking at probably getting about $8,000 in tax savings. If you earn double this, it'd go up to $35,000. And if you're in California, New York State, what's going to happen is these numbers only get better the higher your state tax rate is. So this is something that if you haven't looked into it, is well worth looking into. And so the question becomes, is the juice worth the squeeze? How hard is it, Patrick, to go through and get these savings? Well, the thing I will say is that it's impossible for me to tell you, depending on your state, exactly how this works, because I know more about Georgia, and these are state-by-state legislations. So what I'm going to do is I'm going to go over some of the key considerations I think anybody needs to consider, and then based on these considerations, you can either look into the individual state, or you and I can talk, or your CPA, or like a tax attorney can talk to figure this out. So most of the states can be subdivided into two camps. What I would call a credit methodology, which California uses, and more of a deduction methodology, which Georgia uses. And that really doesn't matter for you specifically when you're thinking about if it makes sense to you. It's just something to kind of be aware of, or your accountant to be aware of. The considerations that matter to you are these 5 questions down here. What type of business do I have, and who are the owners? When do I have to pay the taxes? How do I pay the taxes? How do I make the election? And do I have multi-state income? No matter which state you're in, all of these matter. So some of this is going to be flavored so you can get a sense for how Georgia does it. So you can think, oh, I wonder if my state does this as well. But we are going to have some general rules. So what type of business do you have? Well, in Georgia, you have to be a partnership or an S-corp to make your pass-through entity tax election. The reason why a Schedule C business, so if you have a single-member LLC, you can't do it in the state of Georgia because there's no entity-level tax return, right? It all goes onto that Schedule C on your individual return. So determining which type of business you have is step 1. Step 2 is that in Georgia, for the partnership or the S-corp, all of the owners must be individuals. So if you have a corporate investor in your business, you may not qualify for this. All right, so once that's out of the way, when do you have to pay taxes? Well, as everyone knows, your quarterly estimated taxes get kind of, prorated throughout the year. And what happens is with quarter 4, you have to pay those taxes by January 15th. And you may owe a few more April 15th. But if you want to get the maximum impact when you do this, you're going to want to play it safe and pay all of your state taxes before the end of the year, because obviously if you don't pay it before the end of the year, is it really on your tax return for that full year? And does it qualify as a business expense? Probably not. So I do advise my clients that if you owe that quarterly payment January 15th, go ahead and make it just December 31st, December 30th, whatever gives you enough time to get that done and get all of your payments made before the end of the year. All right, third, how do you pay the taxes? Once again, this could be tricky state by state, but the key thing you need to know is you can't pay these taxes through withholding, you can't pay them from your personal bank account, and you have to pay these taxes from your business account. So in the past, and what you're probably doing now, is you're probably just writing that check through your personal Georgia Department or your state Department of Revenue login, because all these taxes flow through to you in the past, to you individually. Well, you are going to have to create a company login to wherever you pay your taxes, and you are going to want to pay those taxes directly from your business account. So for example, in Georgia, you create a separate login for the Georgia Department of Revenue for your company and pay it through that. All right, how do you make the election? This is going to be one that's going to vary significantly state by state. But in Georgia, what you do is you make an election at the time you file your taxes, and you have to make it annually. And I actually really like this because it means you don't have to commit to it in January of each year, right? You basically can make that election on your tax return, and then you just recertify that every year. There are going to be other states where, for example, you probably certify it, and then you stay that way until it's done, right? And then you have to actually revert it if you ever want to in the future. That one's gonna change year by year. So you definitely want to check with your CPA or tax advisor to figure out how your state does it. Okay. So what if you have multi-state income? This is a big one, okay? Because all the other ones I think are relatively minimal work to get this done. The juice is really worth the squeeze on that one. It's not too difficult to do. But the scenarios I've been describing are all when you have all your income from one state. If you think about it, if all your income's in Georgia, all your income's in New York, all your income's in California, well, you just have to worry about one state's election. But when you have multiple state, revenue sources where you have to file multiple states' returns for your business, well, you might have to look at essentially doing multiple different elections, and you have to figure out if those elections can be recognized, and they actually, kind of mesh with each other. And that's going to be something where it doesn't make things impossible, but it doesn't make things easy, right? It's going to make things more complicated. Where if you have 4 or 5 different states, if you're only going to save $2,000 in taxes, it doesn't make sense. Now, does it make sense at 20 or 50,000? It depends on what those fees are to kind of vet all of those and kind of do all the diligence to make sure that they line up together and actually don't offset each other or anything like that. So that's going to be where things get a little more complicated. So if I had to summarize, who is this for? It's for owners of pass-through entities, typically partnerships or S-corps, people who pay their taxes before year end, people who are okay keeping up with the elections and the business account, which, like I said, I don't think is too bad. And then finally, I think it's easiest for people with single state income. And if your business income is high enough, it's possible with multi-state, but you may want to double check. So my offer to you, and I do this for everyone, is if you're watching this video, I'll offer a free strategy session to review your most pressing questions at no cost or obligation. At the very least, if you don't do this, bring it up with your CPA. They might be doing this already, but it is something that's relatively new. And like I showed you that schedule of states, different states started it last year. Some states started it the year before. Other states are starting now. So it is a moving target. Definitely keep up with it. And if you do have a complicated one with multi-state stuff, feel free to schedule with me and I'll put you in touch with a tax attorney I work with on this stuff. So I hope everybody got a lot from this. Like I said, I only talk about things that I think will save you thousands and hopefully tens of thousands of dollars. But I hope you have a great rest of the day and let me know if you have any questions.